All right, let's talk about Plazm. If you've seen the chart lately, you're probably feeling, well, a little concerned, right? A price drop from over $12 all the way down to under a dollar looks brutal on the surface. But in this explainer, we're going to dig in and show you why this price action isn't just expected, it's actually a core part of the protocol's design.
Okay, before we get into the thick of it, we have to get the mandatory disclaimer out of the way. This is all for educational purposes. It is absolutely not financial advice. Crypto is a high-risk world, so please always do your own deep dive research. All right, let's not sugarcoat this at all. The market is a sea of red right now, and it is so easy to look at the numbers and just feel like everything is going completely sideways. And you know what? That feeling is totally understandable given what's happening out there. And this slide really sets the stage. We're seeing huge assets like Ethereum down almost 9% as the entire crypto market just gets hammered. And right there in the middle of all of it, you see Plazm sitting at 82 cents. Just looking at that number on its own, it's pretty alarming. Which brings us to the question that is without a doubt on literally everyone's mind. When you see a 93% drop from the all-time high, your brain immediately says, I'm losing, I'm deep in the red. It's just logical. But what if I told you that for a whole lot of people, that assumption is completely and totally wrong? This is the number that just changes the entire conversation. For those who got in and staked early, even with the price cratering to 82 cents, their projected return when their stake unlocks on day 77 is over 1,000%. And let's be crystal clear, that's not some fantasy number based on the price bouncing back. That's calculated at today's price. So how on earth is that even possible? Well, the answer is in a concept that is absolutely central to how Plazm is designed. See, it's not about being immune to price drops. It's about having a massive, massive buffer that just absorbs them. Let's break down exactly how this buffer is built. This quote right here, it gets to the absolute core of the idea. The protocol mechanics don't create some kind of magic shield against price. I mean, if the token went to zero, yeah, your investment would too. What it does create is this incredible cushion, this buffer zone that's built from the one thing the protocol values way more than price, and that's time. And this is where we have to be totally transparent. Let's just look at the raw numbers. At the current price of 82 cents, that return is projected around 1,000%. Now, if the price were to fall further, say to 50 cents, yes, the return drops, but it's still a projected 500 to 600% gain. And get this, even at a catastrophic 20 cents, the return is still positive. It is not immunity, it's just an incredibly powerful buffer. So how does the protocol build this buffer? Well, it all comes down to the engine at the very heart of the system, a concept called time-squared staking. This is the machine that generates the shares that protect your returns. To put it simply, time squared, or T squared, is a formula where the shares you earn, which decide your slice of the daily rewards, they grow exponentially the longer you're staked. Just look at the formula. It's your principal multiplied by time squared. That little squared part, that's the secret sauce. Now let's look at what this actually means in practice. After 30 days, let's say you have 900 share units. But if you stake for 60 days, that's twice as long, you don't get twice the shares. No, you get 4 times the shares, 3,600 units. And if you go to 90 days, it's 8,100 units. The reward for being patient just grows and grows exponentially. This is how that buffer gets built day by day. Okay, so T squared built up your personal share buffer, but what keeps the protocol itself healthy, especially when prices are in the gutter? That's where the second piece of this puzzle comes in, a deflationary flywheel that actually gets stronger in a down market. You see, unlike most projects that just print more of their own token to pay you, Plazm has a real yield engine. It generates about $700 a day in USDC from DexFi bonds. And here's the crucial part. That income is completely disconnected from the Plazm token price. Whether the token is at $12 or 80 cents, that USDC just keeps flowing in. So what does the protocol do with that stablecoin income? It runs a constant buy and burn. It takes that USDC, goes onto the open market to buy Plazm, and then just permanently destroys it. And here is the counterintuitive genius of the design. When the price of Plazm goes down, that same $700 of buying pressure actually removes more tokens from the supply. And the numbers here just show the effect perfectly. When Plazm was at $2, that daily yield could buy and burn 350 tokens. But down at 50 cents, it buys and burns 1,400 tokens. That's 4 times as many. A lower price directly accelerates the deflationary pressure, which is a massive long-term strength for the protocol. Now, theory is great and all, but what are people actually doing? I mean, does the on-chain data back this idea up? Does it show that long-term holders actually get these mechanics and are sticking around? Well, let's take a look. The data is just wow. It's incredibly clear. A massive 58% of the entire Plazm supply is locked away in stakes. Another 26% is providing liquidity. 12% has already been burned forever. That leaves only 4% of the supply that's actually liquid and easy to sell. The vast majority of tokens are committed. But honestly, this might be the most powerful statistic of them all. During this absolutely brutal price decline, people didn't panic and pull their stakes out. They did the exact opposite. The total number of shares staked in the protocol went up from 1.17 billion to 1.3 billion. This isn't people giving up, this is pure conviction. The informed players are using these low prices to accumulate even more. So let's put all these pieces together now. We've got the buffer, we've got the time-squared share engine, the deflationary flywheel that loves low prices, and the on-chain data that proves holder conviction. When you combine all of that, you start to see the true innovation at play here. This slide, this is the one that says it all. In any traditional investment, stocks, real estate, even Bitcoin, if the asset price drops 93%, your return is negative 93%. It's a simple one-to-one relationship. But with Plazm's T-squared system, that exact same 93% price decline results in a projected positive 1,000% return for early stakers. The difference is just staggering. And that's really the bottom line, isn't it? The true innovation here isn't trying to stop price from going up and down. That's impossible in crypto. The innovation is creating a system where the rewards you build up over time are so massive that they create a buffer capable of absorbing that volatility, keeping you profitable even in a crazy crash. So how should you reframe that 82-cent price? Well, instead of seeing failure, see the T-squared buffer doing exactly what it was designed to do. Instead of seeing a low price, see the buy and burn machine running at maximum efficiency. And instead of seeing a crash, see an opportunity where patient people are accumulating shares from the impatient. And this all leaves us with one fundamental question. This entire protocol is a machine that was built to reward one thing above all else: time. The wider market is obsessed with the other thing: price. The design forces you to choose which one you believe has more long-term value. So, which one are you focused on? And we'll end with one final reminder. This has all been for educational purposes, based on this source material. All crypto investments carries significant risk, including the chance you could lose everything. Please make sure you do your own research and make your own informed decisions. Thanks for tuning in.